it's just this shock therapy, which is the exact opposite of the extreme medication they gave us when rates were at zero and they were doing all this QE.
Special coverage of the New Orleans Investment Conference is brought to you by Victoria Gold, leading Yukon's new gold rush.
Welcome back to the New Orleans Investment Conference SF Live special coverage. My name is Kai Hoffmann. I'm the @JR Mining Guy on Twitter and the CEO of the Soar Financial Group. And we are joined by Peter Boockvar, editor of the Book Report and the CIO of Blakely Financial Group. It's great to see you in person.
Yeah, same here.
We've done an interview 2 months ago. Lots has happened since. We're obviously here at a gold mining financial conference. Lots to talk about. Lots of news coming out as well this week. Let's start with your presentation topic, which I think is fantastic because the outlook is clear as mud. And what are you going to be talking about?
I think when you're in a tough environment that we're in right now with high inflation, then the central bank response leading to both a compression of multiples and a slowing economy, it's a tough environment for investors. And because it's sort of this post-COVID world, you can't necessarily look at previous historical timeframes to give you guide to what's going on today. We don't have an historical playbook for what happens when central banks go from negative interest rates or zero interest rates and aggressively hike. Yes, you can look at 40 years ago, but rates didn't start out at zero. So it is sort of a new regime, and we can take lessons from the past, but it's still very uncertain about how this plays out. But I think the net result and the bottom line is I still think we have a rough road ahead, both economically and market-wise.
I think a lot of books will be written about this period. A lot of guests this week talked about like the recession back in the 70s and how the similarities are there. But as you said, I think it's a completely different environment. The role of the internet, I think, is really interesting as well. Information flow is much, much faster. Mm-hmm. Do you see some parallels to the 70s? And what did you learn from it, and what can we learn from it right now to maybe invest better as well?
Well, the parallel is we're in a higher inflationary environment, and we have sharp changes in interest rates. I mean, those are the two main things. There are obviously other things that are not similar in terms of the backdrop and context in which that is happening in, and that debt levels are much higher today. Market valuations are much higher today. Economic sensitivity to interest rates is much higher today. So the disease, I guess you can call it, is inflation. The result is higher rates, but it's happening in a much more fragile environment than we had then. So back then it damaged the economy, but didn't collapse the economy. Not that the economy is going to collapse, but I think we're much more. We're much less, we don't have the strength in the terms of the immunity system to deal with this kind of environment where we were maybe a little stronger in the 70s, I guess.
The balance sheet
is the difference.
Completely blown
up. That's where it's the debt levels that really are the structural change relative to the 70s.
Yeah. Well, we're in an interest rate hike environment right now, and we had the CPI print yesterday, which was higher than expected, actually, not by much, 0.1%. But what was the impact of that? I went to Fed Watch tool immediately after the numbers came out, 100% probability of a rate hike and 86% of 75 basis points. What's the outlook there?
So every single data point now, markets are hoping and wishing with their fingers crossed that there would be some hint of softness that would get the Fed to back off. And while the headline number was in line, the core rate rising to the fastest pace in 40 years just reinforced that the Fed's not backing off. And the debate of whether they're going to raise 50 or 75 in November, of course, was solidified that it's going to be 75 and then followed by probably 50 in December. But the Fed does not want to back off, and that's what the markets are hoping for, is that they will. My issue, and I've been a critic of the Fed for a long time, and I have no problem with the destination at which they want to take the Fed funds rate. It should, the days of having negative real interest rates and thinking that's going to be stimulative, I think should be put to rest. It's now the pace and the velocity of these interest rate hikes that I think is now a problem, and that there's no sort of let's hike, take a step back, see what the impact is, and keep on going. It's just this shock therapy, which is the exact opposite of the extreme medication they gave us when rates were at zero and they were doing all this QE.
I had Keith Weiner on, and he mentioned like a wrecking ball that goes from one side of the street, hits a house, comes back to the other side of the street. It feels like that's what's happening. Like we're reacting too aggressively to certain things, and as you just pointed out, rate hikes are a tad too aggressive as well. Do you have a target rate in mind? Like, has the Fed communicated a target rate? You mentioned 4.5%, like, or 50 basis point rate hike in December. Do you see the limit there, the ceiling?
I think the Fed is trying to figure out is, okay, inflation at some point is going to start to decline. Now, it's important to break out inflation between goods and services. Core goods prices in yesterday's CPI slowed to the weakest pace since May 2021. So core goods prices is moderating. It's the acceleration in services inflation that's offsetting that. So the question is where does inflation start to settle out? And it's still yet to be determined because of that acceleration in services. So I think that when you look to next year, yeah, inflation can be about 3 to 4%, and the Fed wants to have the Fed funds rate at least even with that to slightly higher. So therefore, if you look at, call it 4%, that's why they want to get to 4 to 4.5 to have slightly real positive interest rates. But then the question is, okay, looking out past the next year or two, are we just going to go back to the 1 to 2% core inflation that we saw pre-COVID, or are we in a structurally higher inflation environment of, call it 3 to 4? And I think, yes, we are in that structurally higher inflation rate, which means that the Fed funds rate, even when they start to cut in response to a weaker economy, is not going back to zero. It's going to stay elevated.
Okay. You mentioned goods, and I find it quite interesting. We briefly chatted before hitting the record button about the strength of the US dollar and how it's impacting the economies worldwide. Let's talk about that as well, because I think we're also in a different geopolitical environment, meaning with the iron wall, or iron curtain almost back, and companies sort of figuring out their supply chains again.
Right. Import prices have benefited from the strength of the dollar, and that we can buy more with the strength of the currency, but also getting to the point of core goods prices slowing. You know, the global economy is slowing. The global economy also, who spent all the money on goods for the last couple of years, is now shifted obviously to services, so there's less need for goods as well. So that's why you're seeing a sharp decline in transportation costs and a slowdown overall in the accumulation of goods. And that's reflected in, well, if I'm buying less, then prices are going to come down. We've already seen excessive inventories and certain level of goods prices with a lot of the big US retailers, and they're trying to, at least going into the holidays, they're going to see some very big discounting. So that helps to explain why we're seeing a reduction in the pricing of goods prices imported.
Bringing production home as well, or sourcing locally, like even opening mines in the US or so, will drive costs higher as well. Have you factored that in as well, or how does that play a role?
Well, that gets to my point of inflation still being sticky and persistent. Okay. That price is still going to moderate, but they're not just going back to pre-COVID pace. So we have a structurally higher cost of doing business, even though it's coming off the boil.
Okay, gotcha. Give us, to sort of sum up the conversation, a bit of a market outlook. What do you expect the next 3 to 6 months to happen? Strength of the US dollar, is it going to prevail? Things like that.
So certainly the strength of the dollar has definitely surpassed my expectations. I think the key question with the dollar is, has it been just an interest rate differential thing? Has it been really because the Fed has just been more aggressive than everybody else in hiking? And with respect to the euro and the pound, is it just the energy thing? In the sense that if other central banks continue with their aggressiveness in hiking, and the Fed is closer to the end of their hikes, is that enough to cool the pace of the dollar increases? I'm of the belief that, yeah, it's energy, and aggressive Fed has been the sole reasons for the strength in the dollar. I think you can look at the Mexican peso and the Brazilian real, which have traded great over the last couple of years. They're benefiting from being commodity currencies, but also their central banks were hiking well before the Fed. These central banks were hiking in the beginning to the middle of 2021. So that tells me if the dollar is trading weak against those two currencies, that's all this is. So I think we're coming to the peak of the dollar because of those factors that I just mentioned. I think the markets now, the next hurdle to climb is earnings over the next, call it 6 to 7 weeks, and that profit margins and revenues are now compressing. So that's sort of the next hurdle. I mean, we're in a bear market. There are 3 stages to a bear market. First one is you take a lot of the initial froth out and you revalue stocks. We saw that over the past year. The second one is we deal with the economic consequences of the tightening of monetary policy and what that means for economic growth and earnings, which we're just beginning now. The third phase is everyone just throws in the towel, and no one wants to own a stock again. That's the end of the bear market. But we're not close to that. We're in phase 2 right now. So I still think that there's a bumpy road ahead.
Fantastic. Peter, amazing conversation. Really appreciate it. Where can we find more about you?
So you can read my daily missives at bookreport.com, BOOCK report.com, and you can subscribe if you like. And you can also learn about our wealth management services at bleakley.com.
Fantastic. Peter, thank you so much for your time. I know you have a very packed schedule. Thank you so much for making the effort.
Thank you.
Really
appreciate it.
Yep. Everybody else, thank you so much for tuning in. SF Live special coverage from the New Orleans Investment Conference. We were joined by the fantastic Peter Boockvar. Make sure to follow him on Twitter, but also subscribe to his newsletter. It's fantastic. I read it also every day. Much appreciated. Hit that like and subscribe button, and we'll be back with lots more.